Hello students, I am Dr. Masroor Ahmed Beg, Principal of Zakir Hussain Delhi College, New Delhi. I welcome you all to this National Income episode's concluding part. We had already discussed the basic concepts and terminology related to national income in part A and continue with other relevant aspects in this session. Under this session, I strive to explain the methods of calculating national income along with its aggregates. We are going to discuss the following major topics in the current session: basic aggregates of national income, domestic income and national income, measurement of national income among these wide areas. There are many minor topics which I will try to explain simultaneously. Let us proceed with the basic aggregates of national income. Number 1, basic aggregates of national income. In an economy, various goods and services are generated over a span of 1 year by different productive units. In terms of quantity, certain products and services cannot be added together. These are then represented in money terms. These are called national aggregates. In national revenue, there are several aggregates to calculate the valuation of goods and services in terms of money. Gross domestic product at market price, GDPMP. It refers to the aggregate retail value of all the final goods and services generated over a span of 1 year within a country's domestic territories. Gross in GDPMP signifies that no provision has been made for depreciation, that is, it includes depreciation. Domestic in GDPMP signifies that it included goods and services provided by all domestic units, regardless of whether they are provided by residents or non-residents. The GDPMP market price means that it covers the amount of indirect taxes paid and excludes the value of subsidies earned. That is, it indicates that it has included net indirect taxes. In GDPMP, the commodity means that only final goods and services must be used. By making adjustments in GDPMP, we can derive other aggregates. Gross domestic product at factor cost, GDPFC. It refers to the total cash value for a span of 1 year of all the final goods and services generated within a country's domestic territories. GDPFC is equal to GDPMP minus net indirect taxes, net domestic product at market price, NDPMP. It refers to the total selling value over a span of 1 year of all the final goods and services generated within a country's domestic territories. NDPMP is equal to GDPMP minus depreciation, net domestic product at factor cost, NDPFC. This corresponds to the net cash value of all the final goods and services generated for a span of 1 year within a country's domestic territories. NDPFC is equal to GDPMP minus net indirect taxes minus depreciation. Gross national product at market prices, GNPMP, it refers to the total market value of all the final goods and services generated over a span of 1 year by the usual residents of a region. GNPMP is equal to GDPMP plus net factor income from abroad. Gross national product at factor cost, GNPFC, it refers to the total cash value of all the final goods and services generated over a span of 1 year by the usual inhabitants of a region. GNPFC is equal to GNPMP minus net indirect taxes. Net national product at market price, NNPMP, it refers to the net market value over a span of 1 year of all the final goods and services generated by ordinary citizens of a region. NNPMP is equal to GNPMP minus depreciation. Net national product at factor cost, NNPFC, it refers to the net cash value over a span of 1 year of all the final goods and services generated by the usual residents of a region. NNPFC is equal to GNPMP minus net indirect taxes minus depreciation. Comparison between domestic income and national income. Domestic income, national income, it is a territorial concept, since the value of final goods and services produced within the domestic territory of a nation is concerned. It is a national concept that encompasses the significance of the final goods and services produced as a whole in the region. It considers all producers within a country's domestic territories. It considers all the producers who are the country's ordinary citizens. It does not include NFIA, it includes NFIA. Measurement of national income, the most detailed indicator of an economy's output is called national income. Its estimation is, however, an incredibly complicated process. When the process of production takes place, then the factor incomes are paid to factor of production for their factor services. It means there is an income flow corresponding to the output flow. Factors of production spend their income on purchase of goods and services by making consumption expenditure. Thus, production gives rise to income, income results in expenditure, which in turn generates income again. Similarly, national income of a country can be measured by 3 different methods: value added method, income method, expenditure method. Value added method or product method. Value added calculates the amount of business value provided by the company's own contribution to overall output by each company. Its use avoids the double counting statistical dilemma. The sum of all the added value is considered the added gross value. It is a calculation of all the final output produced in the economy by all economic activity. Value added equal to value of output minus intermediate consumption. The value of production corresponds to the retail value of all goods and services generated for a span of 1 year. The following points should be considered while calculating value of output. When the entire output is sold in the same year in which it is produced, then it would be taken equal to the sales value, that is, value of output is equal to sales. If the total output produced in a year is not sold out, then unsold output would be treated as a closing stock and added to the sales value to obtain the value of output. It can also be calculated by multiplying quantity produced and selling price. If the value of sales is given, then exports value need not be considered. However, if domestic sales are given, then to achieve the value of the gross revenue, the export value can be added to it. Intermediate consumption corresponds to summation of all inputs and raw material used in the making of product. If the value of intermediate consumption is given, then the value of imports is included separately, as it was already included in it. In short, intermediate goods are those goods whose value is merged with the value of the final goods. Steps and precautions in value added method. The following are the measures used in the value added process of calculating an economy's national income. Step 1. Here productive enterprises are identified and then classified into the following 3 sectors: primary sector, that is agriculture and allied activities; secondary sector, that is manufacturing, construction, etc.; tertiary sector, that is services like banking, insurance, etc. Step 2. Classified each sector into the 3 different subsectors according to the nature of their activities. Step 3. The deduction from the export value of the value of intermediate consumption, depreciation and net indirect taxes at the cost of the factor gives the value of the net domestic product. Step 4. To achieve the NDP of the whole industry, apply the amount of net domestic product at the factor rate of all generating firms. Step 5. Add NDP at factor cost of all the sectors to get the NDP at FC of this entire economy, that is domestic income. Step 6. Finally, estimating the value of net factor income from abroad and add it with the domestic income to get the national income. Difficulty or the problem of product method. Following are the some of the difficulties faced under value added method. It is impossible to determine if the cash value of products and services is determined at the expense of the supplier, the price of the wholesaler or the price of the retailer. It is not always possible to draw clear cut line of demarcation between the intermediate goods and the final goods. Whether a commodity is an intermediate goods or a final goods depends upon its uses. It is still a matter of dispute whether services should be included in a national income or not. Following elements should be used when measuring national revenue by value added process. Imputed rent for owner occupied houses as the property services it generates, imputed worth of products made for self consumption as they add to the output of the current year, price of own account production by companies, government and households of fixed assets, price of the finished products and services when the finished customers are able to use them, imputed value as these add to the current year of the production of free services generated by general government and private NPO. The value of following item should be excluded: sales and sales of second hand goods. These are not part of the current year's production. In addition, they are already counted in the national profit of the year in which they were manufactured. However, since the sale was done by a dealer, since he offered productive services, his commission or brokerage could be included. Sales and sales of bonds, securities and debentures. Only a capital exchange occurs that does not specifically lead to the movement of goods and services. Income from illegal activities. Income generated from all illegal activities are excluded from the national income. The value of intermediate goods and services is now used in the final goods regardless of their value. Services generated for self consumption are not included in the calculation of national income. Income method. The income method calculates national income in the form of dividends, interest and benefits on the part of payments rendered to the key production factor for their active services in the particular financial year. Therefore, as per to income method, national income is calculated by summing up of factor income of all the normal residents of a country earned within or outside the country during a given period of account. Alternatively, to derive national income, all the money that accrues to the forces of production by way of wages, rent, interest and dividends are summed up. Components of national income. Following are the components of national income. Compensation of employees. It refers to the amount paid to employees by the employers for rendering their productive services. Includes all the payments or the benefits which the employees gets directly or indirectly from the employer against their productive services. It consists of compensation of employees in terms of cash, kind and contribution by an employer to superannuation programs. Operating surplus. It is the joint reward paid to land, capital and entrepreneurship. Land is rewarded with the amount of rent and loyalty. Interest is paid to capital owners for their capital invested, whereas the entrepreneurs are rewarded with profits. Mixed income. Income of the self employed people who are not able to classify their income into rent, interest and profits is termed as mixed income. This is the income basically generated in unorganized sector. Measures included in the estimation of national revenue by form of income. The measures involved in the calculation of national income via the income method are as follows. Step 1, identifying manufacturing industries that use production inputs, that is land, labor, capital and entrepreneurship. Step 2, classification of different forms of factor compensation such as rent, wages, interest, profits and mixed revenue. Step 3, estimation of the amount of factor payment made by each company. Step 4, summary of all domestic factor payments rendered to receive domestic revenue, that is NDP at FC. Step 5, estimating the addition of NFIA to domestic tax to derive national profits. Following are the safeguards needed to undertaken. All factor income obtained by delivering productive resources are included. It is important to consider all forms of conversion revenue. The selling and purchasing of second hand items was exempt because they are already used in the year of which they are made. Imputed rent of owner occupied homes and the cost of own account growth are included. Sale of shares, bonds and debentures are excluded. Income from illegal activities is excluded as these are taken out by previous investment. Wealth tax and gift tax are exempt. Only the value of income and corporate profits tax are included as they are charged on the current year incomes and profit respectively. Expenditure method. The method of spending calculates the final spending of the gross domestic product at the selling price over the accounting period. Usually annually, alternatively it calculates the disposal of GDP, that is the disposal of the finished products and services generated in the domestic economy. This approach is often referred to as the approach of uses and expenditure and the method of profits and disposal. The measures involved in the estimation through the spending process of national income are as follows. Number 1, identification of economic divisions that incur final spending, such as the household or consumer sector, the corporate or manufacturing sector, and the government sector. Point number 2, classification into the following components of final net spending: private final consumption expenditure, B, gross fixed capital formation, C, government final consumption expenditure, D, change in stocks, E, net exports. By summing up all the 5 components, we get GDP at MP. Point number 3, measurement of final spending on the components mentioned. The cumulative total of the final spending on the 5 products referred to above gives us the amount of GDP per MP. We gain NDP at FC by the elimination of depreciation and net indirect taxes from GDP at MP. Point number 4, estimation of global net factor revenue, that is applied to NDP at FC. It is important to take the following precautions to measure national income by expenditure method. Expenditure on all intermediate goods and services is ruled out in order to prevent double counting. Intermediate goods and services are those which are sold by one enterprise to another for resale or for further production. Only the expenditure on the purchase of final goods is considered. Government spending on all transfer benefits such as unemployment insurance, scholarship, old age pension, widow pension, etc., is omitted unless the recipient does not have any economic services in return. Expenditure on the procurement of second hand goods is exempt from national income, since this form of expenditure does not apply to the goods actually made. However, all commissions and brokerages on second hand products transactions should be included, since these are provided against the produced factor services. Expenditure on buying new shares or new bonds or old shares or old bonds, etc., is exempt unless there is no charge for newly manufactured products or services. It demonstrates that property is merely moved from one individual to another. Components of expenditure method. Point number 1, private final consumption expenditure, PFCE. The monetary value of imported goods and services acquired for current use by households and non-profit organizations during the accounting period is measured in this section. PFCE equal to household final consumption expenditure plus expenditure of private NPO serving households. Point number 2, investment expenditure, gross capital formation. Investment involves the allocation of a period of time to the physical supply of money. Investment includes equipment building, construction of houses, etc. Investments are further categorized into 4 categories: public investment, business fixed investment, residential construction investment, inventory investment. Point number 3, government procurement of goods and services. It summarizes the spending by governments on goods and services. Transfer payments rendered to households and companies by the government are not included as part of GDP. Net exports X minus M, the disparity between expenditure on foreign goods and foreign expenditure on domestic goods is seen. The discrepancy between exports and imports is thus referred to as net exports. Recap. Let us recapitulate together what we have done so far. Gross domestic product at market prices, gross domestic product at factor cost, net domestic product at market prices, net domestic product at factor cost, gross national product at market prices, gross national product at factor cost, net national product at market price, net national product at factor cost, difference between national income and domestic income, product method of measurement of national income, income method of calculation of national income, expenditure method of measurement of national income. That is all for today. Hope you have understood. So, we will meet in the next episode. Till then, take care. Goodbye.